The big story today, and that is the rebound that we're seeing almost across the board here after recession fears plunged the markets into that three-day rout. Weaker than expected jobs data pointing to concerns over maybe cracks in the labor market, and that was enough to send jitters throughout global markets. So is that an overreaction, or could we see a steep economic slowdown? For that, we want to bring in Torsten Slok. He's chief economist at Apollo Global Management. Torsten, it's great to have you here. So let me put that question right to you. When you take a look at maybe the market's reaction to that weaker than expected labor data print that we got out on Friday morning, was that a bit of an overreaction? And what are you seeing within the jobs market?
I think that's right, Jana. If you look at, as Jay Powell said last week, the totality of the data, yes, it is correct that the unemployment rate did go up last Friday. And we did see a slightly weaker headline non-farm payrolls at 114,000. But if you look at, in particular, some of the high-frequency data, daily data for how many people fly in airplanes as of last Friday is still strong. Daily data from OpenTable for how many people go to restaurants is still strong. Weekly data for retail sales from Redbook is also still strong. Hotel occupancy rates, the weekly data also still strong. And across the board, there is just not much evidence of the economy either being in a recession or being on its road to entering a recession. So we think that, again, with Jay Powell's emphasis on the totality of the data, that the market is overreacting to just one data point.
Well, it's interesting because, Torsten, it's not just, of course, the labor market. There are several factors that lead to a rout like this, including what we saw with the carry trade and, of course, earnings. I want to point a chart out that you included in one of your recent notes, and it's about the number of AI mentions on earnings calls declining. If this market sell-off that we are seeing right now is in part driven by the unwind that we are currently seeing in the AI rally, does the Fed care? I mean, that seems like a markets issue.
Absolutely. And I do think that that AI stocks are going down for two reasons. They're partly going down because valuations got so stretched and earnings expectations were simply inconsistent with where valuations were. So when earnings just came in a bit weaker for a few of the Magnificent Seven, the market was reassessing that maybe expectations were too high and maybe expectations were too strong for what these companies could actually deliver. And the second reason why you're seeing the AI stocks going down is because of, exactly as you're highlighting, the carry trade unwinding. You've seen a reversal of a lot of trades where essentially investors were borrowing in yen. Remember, in yen, interest rates up until literally 2 weeks ago, interest rates were zero. Now they went up to 25 basis points. But when you borrow at zero and you invest, first, this trade was going into fixed income. Then it broadened out to buying other asset classes, including AI and stocks, in particular asset classes with momentum. Then you now, of course, with a significant unraveling of the trade, simply because dollar yen has moved from 161 down to 144. That means that if I borrowed in yen, now I need to pay back in yen. If yen is more expensive, that means that I need to pay back more. So that's why it is not only about fundamentals that have been softening for the Magnificent Seven. It's also about the reversal of the carry trade, that a lot of investors who borrowed in yen and used that money to buy, including the Magnificent Seven, are now reversing those trades. So that's why the unwind of the carry trade, it becomes important to discuss how many days, how many weeks will it take before we get to the end of that.
Well, Torsten, you brought up a great point. And then my question is, how ultimately should the Fed then be reading into some of that volatility that we have seen? When you take a look at that three-day sell-off, clearly the markets have also started to reprice what they think the central bank should do. And I'm taking a look at the Fed fund futures right now. 75% of traders pricing in a 50 basis point cut at the September meeting. When you take a look at that, is markets simply just pricing in too many cuts at this point?
Yeah, I do think that markets are pricing in too many cuts. It's remarkable what has happened over the last 2 or 3 days. Yesterday, at one point, the market was pricing 6 cuts this year. And now we're back to pricing 4 cuts this year. So that's also telling you that when people say with high confidence, oh, they will cut rates 4 times this year, this is what the market is saying. You should take that with a grain of salt, because just yesterday the market was saying many more, namely 6 cuts. So I do think that when you look again at as Jay Powell has been talking about, the totality of the data, and also importantly, Jay Powell last week emphasized that the anecdotes that are coming in are not only negative, the anecdotes are, in his words, more mixed. You still have a number of tailwinds, in particular to higher income consumers, where you're seeing still strong gains from stock prices going up, from home prices going up. And if you own fixed income, including private credit, the cash flows you're getting at the moment are the highest they've been literally in decades. So the consequence of that is that there's still a strong tailwind to the consumer outlook from still, again, relatively elevated stock prices, high home prices, and very importantly, anyone who owns bonds will know that the interest rate payments they're getting at the moment are at the highest level we again have seen in decades. So that's all support for the consumer, and that's all support for exactly the view that we are not seeing the economy spiraling into a recession. Of course, if the stock market does go down for the next several weeks and several months, then of course we will have a different discussion. But given what trading is doing, at least this morning, that's pointing to that let's just wait a few more days before we again talk about this strong likelihood that many people think that we are in a recession at the moment, because I think the data is proving otherwise.
So, Torsten, there still is a number of data points that we were going to get on the economy, on inflation, on jobs here ahead of that September meeting. But I'm curious, what do you think the Fed should do at this point at the September meeting?
Yeah, I think that they should take a deep breath, and so should we in markets, and say, okay, we did get a data point on Friday that was a little bit weaker on the headline. Remember, before last Friday, non-farm payrolls for the previous 3 months was 200,000, for the previous 6 months was 200,000, and for the previous 12 months was 200,000. So 114, it is a little bit weaker. There was some analysis from the San Francisco Fed suggesting that maybe the weather did lower the number. It could have been closer to 150. So suddenly maybe the headline was not as bad as the market is making it. And perhaps most importantly, the unemployment rate did go up last Friday from 4.1 to 4.3. From the outside, that does look like a serious problem. But think about it. The unemployment rate can go up for two reasons. Either because people get fired and we have more layoffs, but that's not what we're seeing. The Gray, Challenger, and Christmas survey of job cuts is still very low, very few job cuts. The JOLTS data for job cuts and layoffs is also suggesting that there's not any layoffs, where the whole reason why the unemployment went up is likely because of an increase in labor supply, because of an increase in immigration. And that means that, again, even when it comes to the unemployment increase that we saw, probably also has to be taken with a grain of salt. So that's why, Sheila, to your question, I think that the Fed will be looking at the next employment report next week. This is a relatively light week on data this week here. We do get jobless claims on Thursday, but next week we get CPI and we get retail sales. And that's when the Fed will begin to pay attention again.
Torsten, that's exactly where I wanted to go. Let's say you've calmed our listeners that the labor market, it's not that big of a deal. Do we need to be worried about a resurgence in inflation?
Well, that's at least at this point, of course, now the narrative in markets has absolutely answered that with a resounding no. Now the change has gone to other side of the dual mandate from the Fed, namely worrying more about the labor market. But if inflation continues to come down, if the labor market is still okay, well, that means that, and which is our strong view, that we will get that soft landing. That means that if we get that soft landing, which has now been the path and trajectory now for several quarters, then the conclusion is the Fed can then go relatively slowly with lowering interest rates. There's no need to dramatically cut interest rates because there is no dramatic slowdown in the economy.
Really quick, Torsten, final 30 seconds. When then do you expect to declare that we have had a soft landing?
Yeah, so I would actually already say that we have had a soft landing, but what really did throw a little bit of a wrench into the soft landing was indeed the data last Friday. So that's why the discussion in markets should be, is the data last Friday on the employment side and unemployment, is that the beginning of a new trend? Or was it really just a statistical quirk? And now we'll get data that shows, like we got ISM services yesterday, that things are actually not that bad. So that's why the next several weeks, it will become very important whether we still see soft landing or whether the data confirms that narrative that the market is so worried about, namely that harder landing.
All right, Torsten, can't thank you enough for coming on and walking our viewers through this confusing time. We really appreciate it.
My pleasure.
That was Torsten Slok. He's the chief economist at Apollo Global Management. We should also note that Apollo is Yahoo Finance's parent company.